Right, David gave us a great question a little while ago. Can we explain standard deviation, how to calculate, where to find it on the charts, this, that, and the other? Okay. So what we're going to do is work that into how we calculate the expected move. Because when we calculate the expected move that the option market is pricing into a certain stock over, a certain period of time, that is reflective of a one standard deviation move. Okay, for those who are not mathematically inclined, or just quite frankly don't remember what a standard deviation is, or don't care except for how it relates to what we do here trading options, let me show you. Okay, who here, either, if we can remember back that far, which I have troubles doing myself, okay, but who here remembers taking a test in high school, college, whatever it is, and having a curved grade? Or maybe your kids or grandchildren are doing that now. Okay, well, did you really understand what the curve meant? Other than the fact that the teacher, professor, instructor said, we're going to curve this. So that generally bumped up people's grades, because what that usually meant, at least in my classes, when they said they were going to curve it, is that people did really crappy. So do you guys know what that means? Beautiful, Michael. Exactly. So a standard deviation in a curve for what you would see on one of these exams, also known as the bell curve. Okay. This big area here in the middle is where the majority of the people would be. Okay, that is known as the one standard deviation area. Okay? Absolutely, Don. There's people that could get a, theoretically a 40, a 50 and get an A if they came out, as compared to all the other students. Absolutely. So one standard deviation accounts for what percentage? Yep, we call it 67%. It's actually, I believe, the true number is something like 68.26%. But for our purposes, we're going to call it 67%. Okay. Two standard deviation move, which would then encompass the next set of statistics or the next set of grades, or in relation to options, the next set of moves, predicted moves. Thank you, Sirajul. Let's move that into red. That would then be maybe right about here and here. Sorry, that's a little curved line there. And that would encompass the next roughly 27%. So like 13.5% on either side. Okay, so this would be like 13.5% here. This should be the equivalent on the other side, but it's not because my drawing is really terrible. So this whole area then, like Sirajul just said, would be 2 standard deviations. Which is approximately 95%. I think it's really 96%, but we're going to call it 95%. Okay, everybody with me so far? I know you're asking, well, why the heck does this, why are we talking about this? How does this correlate into option trading, option fundamentals, this, that, and the other? Everybody okay with that? Questions yet? No questions? Okay, cool. 3 standard deviation. Let me extend this line here a little bit. 3 standard deviation would come in. Again, please don't take my awful drawing directly to heart. 3 standard deviation adds in roughly another 4%. Okay, so basically 2% on either side. Whoops, let me erase that. Hang on. So 2% there. Oh. 2% there. And 2% here. So that a 3 standard deviation move, which is really the outlying move. Let's do something like this here. Encompasses about 99.8% of all moves, of all theoretical possibilities. Okay. Alan, that is so far above my pay grade, but I'll listen anytime you want to explain it, though. I will be happy to listen to that. Okay. All right. So we got this. We get the math. Okay. And anybody Anybody not understanding what's on the screen yet? I'm going to get to the part how this correlates now to options. But anybody have a question on that before we move on to what it means for us? David, you're the one that asked this question, so you cool? You okay? All right, we get to the next whiteboard. So, the Black-Scholes option pricing model and every derivation of, okay, and I always talk about this, so those of you that have heard me say this, just, bear with me for a moment. I don't mean to be redundant, but the Black-Scholes pricing model is this long mathematical equation, takes in all sorts of factors, and spits out theoretical values of option pricing. Okay, now, you do not ever, unless you really want to, just, for grins and giggles and all that stuff, you do not ever really need to understand the math behind the Black-Scholes pricing model. What you do need to understand, just like if you make a smoothie, you need to know the ingredients that go into the blender. So you need to know the ingredients that go into the model. You don't care how the model works, just like you don't care how the blender works, but you just want to get the answer. You just want to get the end result. That end result, okay, that end result, one of the definitions in the options pricing model is that when we calculate an expected move, okay, based on option pricing, that expected move, Russell, you and me both, that expected move is with a 1 standard deviation probability. Okay, let me put that up on the board. So when we calculate an expected move based on option pricing, this calculation reflects a 1 standard deviation move. Now is when we're going to start talking about how that correlates to what we do. Okay, so David, since you're the one that brought this subject up, please suggest a stock to me. Any stock you'd like to look at. Okay, Royal Caribbean, are you going on a cruise for the holidays? Well, that's no bueno. That's no good. Okay, Royal Caribbean. Let's take a look right now out to January. We're just going to go a month out. Okay? And actually, we're going to go, because strikes are a little different here, we're going to go to January 11th. Okay, January 11th expiration. What we want to do is see what is the market expecting based on all of those factors going into the Black-Scholes model, all of those factors going into the blender, what is the market expecting between now and then, the move, the range that RCL is going to trade in? Okay, and the easiest way to do this without getting into mathematical calculations, to get a really good barometer, is to look at the closest at the money straddle. Okay, because what we want to do is look at the amount of premium, only extrinsic value, not intrinsic value, so only the extrinsic value that at the money straddle is being priced at. Okay, so right now, if we go out to the January 11th options, 107 strike, the stock's trading roughly 107.30, that straddles about $8.90. I'm sorry, $7.90. Okay? If we back out the 30 cents intrinsic value, because the call is in the money by 30 cents, we get roughly $7.60. That is a good approximation for the market expected move over the next whatever days is, 14 or 25 days to January 11th. Okay? So in RCL, the Jan 11th 107 straddle is trading $7.90 and stock is 107.30. So the amount of premium or extrinsic value in the straddle is about $7.60. Okay, was everybody with me on that calculation? Okay, so what the market is then pricing in right now, David and everybody, is if we take the current stock price of 107.30 and we add and subtract $7.60, we're going to get that expected range between now and January 11th. So that expected range is going to be 99.70 up to 114.90. Here is the important part. Okay, here is the important part. That expected range, because of the math behind the Black-Scholes pricing model, that expected range is with a 1 standard deviation probability. So basically the market is saying there is a 67% chance that, or 68% chance, what did I use on the last page there? I used 67, so I'm going to stay consistent. 67% chance that RCL will trade in this range in this time frame. So David, this is how, when we look to capture the proper risk reward to risk for a certain option trade, this is what we are really basing that reward to risk off of. And the probability of a stock moving to some point, some price in the future. This is what we are looking at. Okay, so in the case of, let's just take this to the next step here. In the case of RCL, let's just say for whatever reason, okay, and please do not take this as any sort of suggestion. This is example purposes only. Okay. We now have the market's expected range. Again, 68% probability, 67% probability. Let's say we wanted to sell some premium in there because we thought that the market or this stock would trade in that range, stay in that range till January 11th, or at least at expiration January 11th, be somewhere in that range, top to bottom. So we may want to look at something like the 110, 105, no, excuse me, hang on. What was that range again? That range was 99.70. We might want to look at something like the, it's weird that there's a half strikes there, but the 198 put spread to the downside, and then the, let's say 113, 116 call spread on the upside, selling both. Okay. Now, I can tell you from looking at this, there's no way I would do that. In fact, if I was nearer to the bid, I'd be more inclined to buy this. But let me put this up here. So the Jan 11th, 101.98 and 113.116 iron condor is trading approximately $1.20. Okay. The break evens, again, this is projecting on to expiration, right? Not any fluctuations in the middle, but this is projecting on to expiration. The break evens, if we collected $1.20, would be 99.80 to the downside and 114.20 to the upside. Okay, David, everybody with me? Okay, if we compare this break even to what we calculated as the expected range based on current market conditions, we could see that we're, pretty spot on to the downside, right? So 68% certainty, 67% certainty that we're going to be good to the downside. But to the upside, we come a little short. We fall a little short. Not much, 70 cents. But nonetheless, still short of what the market is saying that upper end of the range could be. Okay. Typically, when we have an iron condor or some other sort of credit spread that aligns with an expected move, okay, we look for close to 1-to-1 reward to risk. Meaning in this case, because we are looking at a $3 wide iron condor, $3 wide on both sides here, a 1-to-1 reward to risk in this scenario would be $1.50. Collect $1.50, could lose $1.50. Okay? In this case right now, At $1.20, it's substantially below that ratio. Okay, so the current reward to risk, if we only collected $1.20, is $1.20 divided by what is our risk? Yep. No, David, the maximum value of the spread is $3, regardless whether the stock goes to 500 or 0. It can never be worth more than $3. The risk would be $1.80 if we're collecting 120. So if I look at the reward to risk on that sort of ratio, I am now way down to basically 0.67 to 1. Far below the risk parameter, reward parameter that I would like to see. Makes a huge difference. Now, 30 cents, Alan, if we had a $20 type of deal, 30 cents is irrelevant. But 30 cents on a $1.50 is huge. So we typically like to look for something closer to 1-to-1 reward to risk. Now again, that 1-to-1 reward to risk is all predicated on calculating the break even compared to the expected range. Okay? If we're going to be inside the expected range, meaning taking more risk, right? So in this scenario, where our break even would be something higher than 99.70 and lower than 115, if we're going to take more risk, we have to get paid more. Our reward to risk ratio would need to be higher. If we're going to take less risk, meaning that for some reason we were going to get enough credit where the break evens would be outside of the expected range, then we would be willing to accept less reward because we'd be taking less risk. Okay, but when we're comparing the reward to risk based on break even of an expected range, that is what we look for. Does that all make sense? I mean, I'm trying to bring in and dumb down the math part of it and really just try to correlate why it's important into how we calculate what that expected move is and how we figure out what strikes that we choose, this, that, and the other. I'm hoping, David, that this is what you wanted to see, what you wanted to get at. Okay? Does anybody have any question? Thank you, Alan. Increase what percentage, Michael? You mean to move out and look what that 2 standard deviation move is? To figure out the break even at that point? Yes, there is. And let's do that. We'll schedule another time to do that. But remember, if we do that, okay, and if we go out and we make a trade, whatever the trade is, iron condor, call spread, whatever it is, that theoretically has a 95% chance of winning rather than a 67% chance of winning, what should that do? What should that do to the price of our spread? If it's a credit, it should do what? No, it should decrease the amount of credit that we receive. Right? If we're increasing the probability that the trade is going to work, right? Because we're now expanding out to 95%. From a credit standpoint, we would be collecting less credit, increasing the amount of risk to the trade if it didn't work. So we'd receive less credit, which would then give us more risk, but that's offset by the higher probability that the trade is going to be successful. On the flip side of that, if we're looking at a debit, buying a put, buying a call, but way out where more than likely the trade is not going to work or not be successful, 95% chance that it's not going to be successful, then we would expect to pay a heck of a lot less for that option or that spread, whatever it may be, because the probability of that trade working is so much lower. Is that clear to everyone? Now, certainly other things you want to factor in here, right? This is just the math part of it. You certainly want to look into, in whatever stock you're looking at, okay, how do those break-even ranges, up and downside, how do those break-even ranges correlate to any support resistance there might be in a stock, other technical factors in a stock? And if you start seeing some patterns, some correlations there, that could either enhance or maybe detract from the amount of credit you would get in a spread. Okay? Make sense? Perfect. So Michael, funny that you say that, because behind the screen here, It's like, Wizard of Oz, don't pay any attention to the man behind the curtain there. I actually adjusted the strikes here slightly to see how that would affect the reward to risk. And here's what I adjusted it to. I actually just adjusted it to $2.50 wide to the downside, but $2 on the upside, just to see. Okay, but sometimes that is what you guys will see me doing. When I say to you guys, all right guys, you're just going to kind of see me tooling around on the screen here and changing some strikes here and there to see if I can make something align. That's what I'm doing. That's exactly what I'm doing. Okay? All right. Well, hopefully that was helpful to most everyone. If not, be happy to do the follow up or anything. I will do the 2 standard deviation move one, but let me get this thing going here. Let me get the video edited, what do I call it? Rendered, thank you. Get that posted up in the room as well as the whiteboard notes. And I will be back. Thanks everybody for your time. And David, great question earlier. Again, guys, perfect example of why I always encourage you guys to ask anything you want.